But still, just because an institution is using margin, that doesn't make it safe. Obviously, we saw that with Archegos Capital earlier this year. Hey everybody, Walrus here from Walrus Street, bringing you your news and earnings for the week of June 21st, 2021. Just a reminder, I am not a financial professional. All information in this video is for entertainment purposes only. Don't know about you guys, but I am so glad that week is over. You know, I got a little spoiled there. We had a couple of green weeks in a row. Last week, if you remember my video, I talked about the Dow Jones going down. Well, it went down even harder this week. In fact, all of the major indices finished up significantly lower than where they started the week. So all in all, it was pretty bad. One of the leading theories as to why there was a big sell-off this week is because there were rumors that the Fed is going to be increasing rates sooner than expected to combat the inflation that possibly might not actually be transitory, as Jay Powell has said time and time again. But in my mind, I'm having a really hard time rectifying this, because if people are afraid there's inflation, personally, I don't understand why they're selling off equities. Where else do you go with your money right now? Take a look at the charts for gold. Gold is dropping. Okay, well, I thought gold was a haven. Right now, bonds and treasuries aren't going to be worth anything if the Fed raises rates. So buying them at present isn't really a great idea. Bitcoin's price is too volatile to be used reliably as a store of value at this point, and I think the adoption is still a little bit too low for that. So seriously, I don't know. Where do you go with money if you're afraid of inflation? Seriously, I'm asking you guys, go ahead and write down your suggestions in the comments below, because I don't know. The only thing that I can think is that I'm going to stay in equities, try to pick some more stable ones if something does go down, because I personally have a 30-year timeline before retirement and I can wait out a storm, but I really have no idea what else to do. Anyway, it was kind of a week full of negative news, so I tried to pick out a few positive stories to share with you guys. Let's get started. First news story. This isn't one of the positives. I swear, I'm not trying to just rip on Ride on this channel, but it's like every single week there's a new story about Lordstown Motors that is just absolutely hilarious. We're actually witnessing the self-immolation of a company in real time. Lordstown Motors slumps most ever on CEO exit and misstatements. What are those misstatements? Well, lying about the pre-orders, which was exposed in the short report back in what, February from Hindenburg? Lordstown Motors shares took their biggest one-day drop ever after its two top executives stepped down and the electric truck maker's board found evidence of inaccurate statements dimming the shine of the one-time SPAC star. CEO Steve Burns and CFO Julio Rodriguez have resigned from the company effective immediately, the company said in a statement Monday. Burns declined to comment about his exit in a text message. Shares of the company sank 19% to close at $9.26, the lowest in almost 3 weeks. The stock was down 54% this year and more than 70% below its closing high of $31.40 in September. This is kind of the realistic perspective here, though. If you're wondering, okay, is this good? Is this bad? Because the stock price has gone up. The stock may come under further selling pressure from potential stock disposals by Burns, who is the single largest shareholder with a 26.5% stake. So here we go. We've got the CEO, Steve Burns, and the CFO getting axed from the company. They walked away effective immediately, and it was because of the misstatements. Wow, that's a really, really nice way to say freaking lies about their pre-order information. We've covered that extensively on the channel. I don't really have to get into it, but this is some kind of dose of reality right here. Burns, once he's eligible to sell his shares, owns 26.5% of the shares of the company. So when he sells those out, it is going to cause a massive, almost dilutionary event where suddenly 1/4 of the company's shares are available to trade. And this is really going to push down the stock price even further when that happens. Probably it's going to happen sometime this fall also, so we can't expect that. Some of you might be wondering, oh, if you're so cocky about Ride going down or the price going down, why don't you short it? Well, Ride has one of the highest IVs of any stock on the market right now, and it's actually not worth it to short because the potential net gain is so low because the IV is high that your cash can be better spent elsewhere. So even though I know the company's failing, every sign points towards the company failing, it actually doesn't pay to bet against the company right now. If we take a look at the chart for Lordstown, you can actually see on Tuesday here, there was a green candle after after the CEO and CFO walked away from the company. So to some people, this actually looks like it might have been good news about their departure. Probably blind hope, but there are some people who still believe in this company. Honestly, I wish them the best. I don't want to see anybody lose all of their money, all of their investment, but this is on some shaky ground. Next news story, and one of the reasons that my trading portfolio was positive on the week despite the negative overall outlook of the markets. Torchlight declares a special dividend of the new Series A preferred stock. I covered Torchlight a couple months ago on a DD video, and for those of you who didn't see the video, watch it. Seriously. If you don't want to watch it, I understand. I'll give you a quick synopsis. Torchlight is an energy company with land and assets in Texas in the Oro Grande Basin. And they are basically stopping their company works, and they're merging with a company called Metamaterials that makes futuristic engineered materials. And Torchlight is almost acting like a shell company to bring Metamaterials into the US stock market. What's happening is that Torchlight is selling off all of its assets, and it's going to be paying off its assets as a special dividend to its shareholders. They announced the special dividend of Series A preferred stock to be issued on a 1-for-1 basis to common stockholders of record as of the close of market trading on June 24th, 2021. This date right here, June 24th, 2021, I actually found a little bit of a discrepancy. This report was released at 5:30 a.m. on Tuesday, and the CEO for Metamaterials tweeted at 6:07 a.m. on Tuesday. So he tweeted right after the PR, and he said, nice release by Torch. The dividend date is 6/24, 10-day notice required. There's a T+2 rule. So the last chance to be in Torch Energy is Tuesday, 6/22 at the end of the day. So a little bit of a discrepancy there. The PR from the company says 6/24, but it doesn't mention the T+2 rule. Thankfully, the CEO of Metamaterials ended up clarifying that and saying you have to be in by the end of trading on 6/22. Now, this creates a very interesting situation with the company because it's dissolving, but it's paying out a dividend worth all of its assets, which we believe is going to be somewhere between $1 and $20 per share, according to the CEO. Now, the reason this creates a slightly interesting situation is because about 12.2% of the float is shorted of Torch. Now, this isn't an incredibly high percent, but the problem here is because the company is paying out a dividend for the Series A shares, anybody who is short the stock has to buy it back or risk paying the dividend, and we don't know what the dividend is. So there's been this mad flurry this week to buy up the stock to make sure they have the stock by 6/22, end of trading, to get them off the hook for paying the dividend. There's people that are saying short squeeze, and in a way it is, but I don't think this one is going to squeeze as violently as some of the others have squeezed this year. And I really hate the term short squeeze. Let me go ahead and put that out there. I think it's used way too much. But let's take a look at the chart and I'll show you what I mean. So we know that 12% of the float was shorted. The float for this company is about 120 million shares. So 12% is going to be about 14 million shares. Look at the trading volume up here just from Friday, 76 million shares. We also had the price run up here. You could see even after hours, we're at $6.70 a share. Just in the last week, we have gone from an open of $3.43 to a close of $6.27, $6.69 after hours. The stock has doubled in price in 1 week. The percent float shorted, 12%, in my opinion, could have easily been covered already with just the volume on Friday alone. And that announcement about the special dividend was made on Tuesday. So there's been plenty of opportunities here for the shorts to have covered their positions at a lower price. But now it becomes a little bit of a self-fulfilling prophecy where if retail doesn't take the time to look at the numbers here, are they going to continue pushing up the share price, believing that some sort of short squeeze is happening, push it higher and higher and higher? I don't know. My opinion here is that the share price is going to rise through business close on Tuesday, and then we're going to see a little bit of a plateau and decline, and then pre-market on Friday, so June 25th, which is after the XD date, you're going to see a huge dump of shares because as long as you're on record as having the share on 6/24, you get the dividend. So I think on Friday, we're going to see a huge share dump because a lot of people aren't going to care about having their shares converted into metamaterial shares. Anyway, that's how I think this is going to play out. Rise up into Tuesday at the end of market close, plateau or a little bit of a decline leading up to Thursday, and then a huge dump on Friday pre-market. Ihor Dusanowski on Twitter, who is the CEO of S3, which is an analytics company for stock market, actually has Torch right now as his highest short short squeeze risk score at 100 of 100. So take that for what it's worth. Now I want to take a look at the drop this week from a macro perspective. The Dow falls more than 500 points to close out its worst week since October. Traders were worried that the Federal Reserve could start raising rates sooner than expected. And this came off the back of St. Louis Federal Reserve President Jim Bullard on CNBC saying that it was natural for the Fed to tilt a little hawkish this week and that the first rate increase from the central bank would likely come in 2022. His comments came after the Fed on Wednesday added 2 rate hikes to its 2023 forecast and increased its inflation projection for the year, putting pressure on stock prices. Jay Powell comes out Wednesday, says that the Fed is going to be increasing rates a couple times in 2023. They're expecting inflation to carry out through the rest of the year. Bullard came on CNBC after that and said he thinks the rates are going to be hiked at the end of 2022, which is much sooner than expected. So you had all of this information coming hit after hit, and a lot of people believe this caused a big sell-off in the equities markets this week. Comically enough, Bullard is only one of the Fed presidents. Minneapolis Federal Reserve President Neel Kashkari said on Friday he wants to keep the U.S. Central Bank's benchmark short-term interest rate near zero at least through the end of 2023 to allow the labor market to return to its pre-pandemic strength, and he said this on Friday. So Wednesday, we had Powell coming out, the Fed chairman, saying that there was going to be a couple of rates in 2023, inflation's going to last. After that, we have Bullard, one of the Fed presidents, getting on CNBC saying he thinks the rates are going to increase by the end of 2022, and then we had Kashkari come on and say on Friday that he thinks that nothing's going to happen until the end of 2023 as originally planned. So you have 3 different people from the same organization giving 3 totally different dates. Market didn't know what to do, and there was a huge equities dump. To me, that doesn't seem like a really solid idea, and I'm wondering, was there something else driving the sell-off on Friday? Because most of the sell-off did happen on Friday. Now, at the beginning of this week, adding to the whole inflation concerns, Jamie Dimon, who's the CEO of JP Morgan, said that JP Morgan is hoarding cash right now because there's a very good chance inflation is here to stay. This was actually a very astute observation from the JP Morgan CEO, because he came out and said inflation is here to stay on Monday, 2 days before Powell came out and said the same thing at the Fed press conference. So this kind of added to the concerns because JP Morgan is a very influential financial body and people do listen to it. And there was a lot of hesitancy and trepidation in the markets throughout the week. JP Morgan Chase has been effectively stockpiling cash rather than using it to buy treasuries or other investments because the possibility higher inflation will force the Federal Reserve to boost interest rates, Dimon said. This is the key takeaway right here. Rather than using it to buy treasuries or other investments, those other investments most likely being bonds. The reason for this is if JP Morgan uses that cash and buys treasuries, buys bonds, and then the Fed goes and increases rates, suddenly their treasuries and bonds are worth a whole heck of a lot less. So it's not like they're stockpiling cash because that's the best thing to do. It's just that this is cash that was going to be allocated for treasuries and bonds anyway, and they're keeping it on the sidelines until there is a rate hike, or at least that's their short-term plan. The other idea for what happened in the markets this week, and this is the idea that I kind of prescribe more to because the Fed gave us 3 different answers, 3 different mixed signals this week, is this: witching sparks volume burst following stock market lull. In a week where even a hawkish Federal Reserve failed to shake the equity market lull, Friday brought some fireworks. Stock transactions spiked amid a quarterly event known as a triple witching when options and futures on indexes and equities expire. Almost 15 billion shares changed hands on US exchanges, about 40% above the 3-month average, while the benchmark slipped 1.3%, the most in more than 5 weeks. While this robust volume offers a window of liquidity, it can also make it hard to tell whether a stock's move is driven by adjustments related to option expiration or by a change in business fundamentals. Basically, because of this witching event, you shouldn't overreact, or you should barely react to any type of movement in the stock's price towards the end of last week. Witching on Friday was actually a quadruple witching, not a triple like Bloomberg said. So a quadruple witching refers to a date on which stock index futures, stock index options, stock options, and single stock futures expire simultaneously. While stock option contracts and index options expire on the 3rd Friday of every month, all 4 asset classes expire simultaneously on the 3rd Friday of March, June, September, and December. That was Friday. While it may result in increased volume and arbitrage opportunities, quadruple witching does not necessarily translate to increased volatility. You could actually see this on Friday because you had these really narrow trading windows for a lot of the stocks where there was a massive volume increase, but the candles were still pretty small on a lot of the stocks, particularly those in the S&P 500, the large caps, mega caps. Quadruple witching days witness heavy trading volume in part due to the offsetting of existing futures and options contracts that are profitable. Now, what does this mean for next week? Following the week of quadruple witching, market indices such as the S&P 500 tend to decline, perhaps due to exhausting the near-term demand for stocks. During that quadruple witching day, there was a lot of buying and selling, billions of shares trading hands, and if you look at the charts for like the S&P 500, the Russell 2000, the Dow Jones, you'll see at the end of the day on Friday, huge downward spikes, and this drove the prices down at the end of the day. Now, that means all those purchases were made, the funds were rebalanced, everything happened, everything's done, so there's not really going to be any upward buying pressure this week on the stock market. So you're going to see a lot of flat stocks for this week, and you're going to see a lot of negative stocks, because if there is a selling impetus, it's more likely to fall to the negative side than to the positive side. During this dip, we actually have had commodities prices come down this week, and there's a few macro events for that involving China releasing some stores of commodities. But Goldman's Curry, one of their analysts, says buy commodities dip and the bull case is intact. The only thing that can fight real physical inflation is rate hikes, not talk of rate hikes, he said. The bullish commodity thesis is neither about inflation risks nor Fed forward guidance, it's about scarcity and strong physical demand. So there's some people that are kind of conflating the whole monetary inflation with the commodity supercycle, and that's not really what's driving it. Historically, inflation leads to an increase in commodities prices, commodities value, but this one has the added benefit of scarcity coming out of COVID when our production had declined. There's a couple of reasons for the commodity supercycle, and this Goldman's analyst is saying we're still in it, it's still going, this is just a temporary reprieve, a temporary sell-off, and to buy in on the dip. Kind of aligning with this, you guys know I talk about Cleveland Cliffs on this channel a lot. This week, the analyst for JP Morgan, Michael Glick, who's covering Cleveland Cliffs, rated them as overweight, a buy, gave them a $39 price target within the 12 months, which is a 72% upside. In his report, he talks about the commodity supercycle, and he talks about the position that Cliffs is in, and he said even if the steel prices drop off, the company's free cash flow right now and the windfall that they're getting from these increased steel prices is going to be driving the future value of the company. Really bullish. However, if you look at the chart for Cleveland Cliffs, you did see a massive sell-off this week. Just on Monday, we opened at 24, we closed at 22. We lost 9% in a single day. And then the rest of the week, we ended up dropping to 2027 by close on Friday, aftermarket down to 1998. I had mentioned on Twitter this week that I was going to reopen a position on Cliffs because the volatility died down. This sell-off actually increased the volatility again, so I got to wait for it to chill a little bit, but I am going to be reopening a Leaps position in Cliffs pretty soon because of this sell-off, because I know the commodity cycle is still going on, and I still am really bullish on Cliffs' future. But there was something else that pushed this sell-off even lower than I thought it was going to go. Arcelor offloads Cleveland Cliffs shares to fund its new $750 million buyback program. So Arcelor is another steel company, and they had some Cleveland Cliffs shares in exchange for giving Cliffs some of their U.S. processing facilities. It was part of a sale of ArcelorMittal's U.S. operations. Now, they ended up selling these shares this week. It amounts to 38.2 million common shares that they sold, and if we look at Cliffs' free float, it's only got 454 million shares of free float. So this share sale by ArcelorMittal was equivalent to about 8% of the float of Cleveland Cliffs. Obviously, this is enough to move the price significantly and depress any gains for the week. Some more positive news for AMD. A couple weeks ago, we talked about AMD partnering with Tesla to power Tesla's gaming rig that's going to be included in its cars. Google's Cloud taps AMD for new service as chip wars heat up. AMD and Google Cloud on Thursday said Google will offer cloud computing services based on AMD's newest data center chip, a move likely to intensify AMD's push to grab market share away from Intel. It will start offering services based on AMD's Milan server chip, which AMD released in March. Google said customers such as Snap and Twitter are testing the new AMD-based services. So it seems like AMD is getting a partnership with all of these huge, massive companies, and they're really setting themselves up with these partnerships for the future. After the news was released, we had a 5.5% gain on share price, open at 80.77, close at 84.56. Though this doesn't seem like a lot, a 5.55% increase on share price, keep in mind, AMD has 1.22 billion shares outstanding. It's really hard to move share price when a company has 1.22 billion shares outstanding. So the fact that this moved over 5% is really shocking off this Google news. We didn't get this much of a lift off the Tesla news, so this is even more bullish, and I'm happy for anybody who's in on AMD. AMD. Now, I was looking at my accounts this week. I wasn't really making any new purchases, but I was looking at my margin. You guys know I have 4 trading accounts. I have one with Robinhood, one with Webull, one with Fidelity, one with M1 Finance. Now, I do most of my trading in Robinhood and Webull, and I was looking at the margin that I had out in my accounts. Now, on all of my trading accounts except Fidelity, I do use margin on some of my trades to maximize my own liquidity. Now, I'm pretty cautious with the margin, and I never get in danger of getting margin called. I don't use that much of it. But I was thinking, I wonder how many people are using a ton of margin with the stock market being as hot as it's been for the last year plus, and I wonder how many people are actually getting margin called. So I went on the FINRA website, and I was just kind of looking around, and I found their margin statistics. You know, this is really funny because the debit balances in customer securities and margin accounts for May 2021 was the highest ever in the history of FINRA data. Highest ever. And these are shown in millions. So this is 861,626 million. So that's $861 billion. That's close to $1 trillion in margin accounts. I'm not really sure what the implications of this are, but I know it's really easy to blow up a margin account. Now, I assume most of these margin accounts are not retail investors. I'm sure with numbers like this, it's probably institutional margin that's being talked about and reported here, the bulk of it. But still, just because an institution is using margin, that doesn't make it safe. Obviously, we saw that with Archegos Capital earlier this year. Last week, I played an option on Volt. Volt Information Sciences reports the second quarter fiscal 2021 financial results. Revenue was a 7.1% increase to second quarter. Adjusted revenues up 5.9%. Gross margin increased 80 basis points year over year to 16.4%. If you remember when I was doing my thesis on why I was going to be making this investment, part of it was the gross margin increase they already had on their last earnings report. This ended up feeding into it. And funny thing, if you read the entire transcript, the CEO talks about the gross margin being a leading cause of their improved earnings. So good job, Walrus. GAAP EPS was 8 cents per diluted share compared to a loss of 25 cents per share in the second quarter of 2020. No kidding, COVID. Adjusted EPS was 12 cents per diluted share. This was a big one. The adjusted EPS, 12 cents per diluted share. The analysts were forecasting the adjusted EPS would be negative 1 cent per diluted share. So from negative 1 to 12, this is a 1,300% increase on EPS off the analysts' expectations, which is obviously just patently absurd and uncommon. This earnings report was better than I could have anticipated, and I thought it was going to be pretty damn good. So I'm feeling really good about this call after hearing this earnings report. This is kind of funny from the CEO. Thanks to the continued execution of our improved sales and delivery model and our disciplined cost management, this quarter reflects our strongest year-over-year revenue growth in a decade and our first positive GAAP net income in 14 quarters. The GAAP net income in 14 quarters, this is incredible. We're paying attention to this company in their first positive net income quarter in over 3 years. But this right here, this quarter reflects our strongest year-over-year revenue growth in a decade. Come on. Like, what happened a year ago, second quarter? This was on the COVID drop. Of course, people weren't hiring and using a staffing agency. This is one of the most misleading statements. When I read this in the earnings report transcript, I actually started laughing to myself out loud, because why would you deliberately say our strongest year-over-year revenue growth in a decade and totally leave out the pandemic that crushed the economy around the world before the rebound? I mean, come on, that's like sensationalized reporting. Now, with all that news, we did have a pretty decent week. We opened up on Monday at 395. We ended up closing at 398 down to 395. Keep in mind though, this is a small cap stock and we did have the big market sell-off towards the end of the week. At the high point, we did hit 440. So I do believe we're establishing a new line of support here right around 390 and that the stock is going to be kind of going up from there. The options that I purchased were months out and I'm not really worried about this one. I kept them open through earnings and I'm going to just keep holding them. The company's earnings report was phenomenal and I'm feeling pretty good about this one. Let's take a look at the upcoming earnings for the week. A lot of companies on here that not many people know about. Plug Power, another one of those hydrogen power companies that I think is way overvalued that everybody loves. Korn Ferry right here, who is another staffing company but mostly for executives. Patterson is a veterinary supply company. They recently bought out Miller, and Miller was the main distributor of the Zomedica Truforma product. So Patterson is now technically the distributor of the Zomedica product. There's a correlation here between Synex and Concentrix. Synex was the parent company. Concentrix ended up spinning off of Synex. I think it was last autumn. There was something connecting these two. CarMax I'm going to be looking at as a preview to the Shift earnings because CarMax is the largest used car dealer in America. Of course, I'll be paying attention to BlackBerry, but I'm not really expecting a great earnings report from them. Gypsum Management and Supply, GMS down here, was another one that I was thinking about getting into. The problem is Gypsum Management just started being traded a couple months back, and it's already up like 300% off of its IPO price. The company sells steel and drywall and building materials, and with the housing boom, obviously, their revenue is really incredible. But the problem is, I believe everybody's already jumped onto this, so I don't really want to touch Gypsum. I think they're getting a little bit overvalued, and their PE is really absurd right now. So, though I find it interesting, I'm not going to touch Gypsum. However, Worthington Industries, this is going to be my options play for this week, and I really had to think hard about this one between Worthington and CalAmp. I think there's a merit to be said for both of them, but let's take a look at Worthington. Worthington Industries deals with high pressure composites, industrial components, industrial gas, propane cylinders, retail products, steel, suspended ceiling, grid systems, and water systems. More or less steel, tanks, that type of thing. It's an industrial company, but they have a huge portfolio of other companies that most people would recognize, the largest of which being Coleman. Coleman Camping Gear is owned by Worthington. Recently, Worthington has been changing its business a lot, and it's had a lot of different shifts in the business. And one of the things they just did at the beginning of June 8th, 2021, they acquired Shiloh's US blank light business. This is a welding company. Worthington, over the last year, has been divesting its energy, natural gas aspects of its business and moving towards steel prep fabrication. And this type of move is really big given the market conditions. This acquisition of Blanklight gives them additional income, and it gives them an added capability to weld and to deal with materials processing in this commodity supercycle. What's really attractive about US Blanklight, the purchase price for the business in the acquisition was approximately $105 million. In the calendar year 2020, the acquired assets generated a net revenue of $170.5 million and an adjusted EBITDA of $20.5 million. In the fiscal year 2020, which was a down year for the entire economy in the globe, this Blanklight company generated $170.5 million and $20.5 million in EBITDA. That means at a purchase price of $105 million, it's only going to take 5 years at the worst, with a COVID low as our benchmark, for Worthington to make back their initial investment. Shockingly, and for reasons that I don't understand, since this announcement was made, the company's share price has absolutely tanked. We went from the day of the announcement opening at 67.63. Since then, we've dropped every single day, and we closed at 56.83, hitting a low of 56.48. This is the daily chart. So since that announcement, we have had 8 consecutive days of losses. If we take a look at their financials, you could see their revenue is pretty solid. It's going up every single quarter. Their net income had a huge increase, and part of this was the divestiture of its energy aspects of its business, and it's been making money selling Nikola stock. Yeah, that's a weird one. So Worthington at one point was one of the largest shareholders of Nikola at the early stages, and at its highest it owned 5.5% of the Nikola shares, and the company ended up making colossal gains on Nikola, totaling a net return of something like $600 million. The company's market cap is only $3 billion, so they ended up making back 20% of their market cap just selling off their Nikola shares. They sold the rest of them on their last earnings report, so their net income's really high, and they've been using the money they made from the Nikola investment to buy companies like Blanklight. So I think the future for this company is really great, and the technicals indicate to me a bit of a buying opportunity, and I'm going to show you why. Now, I know I drew some lines with crayons, but you could see the uptrend line here back from May 2020 to present. We actually just breached this uptrend line after that announcement. So we're down below the uptrend, and we've reached kind of a strong support here. And this support used to be a line of resistance that was touched about 6-7 different days. So right now it's at a pretty long former line of resistance, and now I think this is going to be a pretty strong line of support. Now also, it's not just me saying that. The company just paid out its dividend, so the stock price dropped, and the RSI is really oversold, super oversold. The 6-day RSI is down at 10.3 and the 14-day RSI is at 26.4. Anything below a 30 is oversold. The MACD is trending extremely low right now. This is the lowest that it's been since the COVID drop. Everything on this chart looks to me like we're going to have a little bit of a reversal, and not like I actually like Zacks, but Zacks is saying that you should buy the dip in Worthington. On second thought, since Zacks is saying that, I kind of want to reverse Zacks. Forget it. I'm not doing any of this. If we look at the options chain right now, obviously I'm not going to do anything July 2021 because that's too soon. But if I move out to December, I haven't decided which of these I'm going to be getting. It's either going to be the 55, the 60, or the 65, and it's going to be depending on the market movement on Monday morning, which one I want to get. I'm expecting the earnings report to be pretty solid, but it's not going to be great because they're going to not have any more of the Nikola share sales income coming in. They're going to have the expenditure for the acquisitions. They're not going to have the divestiture gains for their energy aspects. So the net income should see a little bit of a hit quarter on quarter. That being said, the company does process steel, and with steel prices as high as they are, I think the company's revenue is going to be higher than expected. So all in all, I'm expecting a wash on the earnings report. The earnings report is not going to be the catalyst here for me. The catalyst instead is going to be the turnaround. The company talking about future guidance with Blanklight being added into the corporate fold. So I'm going to be buying options out as far as I can in December. Like I said, I'm either going to be getting the $55, $60, or $65 strikes. The IV's pretty low. So I think this is going to be something that I'm going to be holding way through earnings towards into the future, towards December. And then I'll sell it as usual when it hits a 20 to 30% gain, which if the share price recovers to where it was before this drop, that's going to be real soon. It's not going to take an unheard of move. If it gets back on that uptrend line, then we're going to hit that 30% plus really quickly. All right, everybody, that's it for me today. I hope you enjoyed the video. No DD video this week, but I might drop another surprise on you guys sometime this week. If I have time, there is a company that I'm looking at. As always, if you enjoyed the video and you want to support the channel, please use my Webull referral link below the video. If you sign up for an account using that referral link, you get a free stock, I get a free stock, everybody wins because I'm partnered with Webull. The free stock that I'll be getting is worth $30 or higher. If you enjoyed the video today, please like the video, subscribe to the channel, and if you want to be alerted to all my content as soon as it goes live, make sure you hit that notification bell. All right, everybody, thanks a lot. Good luck trading. Have a safe week. I'll see you next time.